So we are going to continue from where we left yesterday. Okay, fine. So now we are going to see, if you are going to invest in a subsidiary halfway. For instance, let's assume all this time we were discussing, if this is our financial period, which is starting, let's take easy months from January to December. So all our acquisitions or the investments at the moment was in January. So mid-year acquisitions means, what if we purchased after 3 months? What if we purchased after 6 months? Okay. So how we are going to consolidate our statement of financial position? How we are going to consolidate our statement of financial position? So now they are telling us, when you are purchasing, you need to make sure that you need to prorate your subsidiaries' profits. I'll tell you how to do it. You need to understand what is the profit before and after. In other terms, we can say pre and post. Pre means what? Before purchasing. Post means after purchasing. The profits. Okay. Then we'll see through this example, so that it will make sense to us what we are trying to do. Now see this company. Power stock company acquired 80% of Sherborne's company shares for $530,000 on 30th September 2013. On 30th June 2014, Power Stocks Company's retained earnings were $770,000. Sherborne Company's share capital on 30th June 2023 was $200,000. So who is Sherborne Company? Is our subsidiary, and its retained earnings were $360,000. So its retained earnings were how much? $360,000. Sherborne did not issue any shares for 30th June 2014. Cool. So now they are asking, Sherborne Company made 80,000. They are making how much? 80,000 worth of profits in the year 30th June 2014. So in the financial year 30th June 2014, they are making a profit of how much? 80,000. The value of non-controlling interest is also given at the date of acquisition, which is 140,000. Power Stock Company had a financial year in 30th June 2014. Okay. So then they have asked us to calculate the goodwill which is arising. Okay, fine. So the first thing that we need to understand from this question is, what is our financial period? So Power Stock is our parent. Everyone agrees to that? And Sherborne is our subsidiary, because Power Stock has invested 80% on Sherborne. When did they invest? On 30th September 2023. This is the date that they are investing. So what is the financial period for Power Stock? Now we need, who prepares the consolidated financial statements? Parent. So if parent is preparing the financial statements, we need to take the parent's financial period. To when did they start and when are they going to end their financial period in preparing their accounts. So they are preparing the accounts as of 30th June 2014. They are preparing to 30th June 2014. So which means they would have started 1st of July 2013. So this is the financial period for whom? To the parent. So this is our financial. Let's assume we are the parent. We are the one who is going to do the consolidations. So our financial period is 1st of July 2013 and it ends on 30th June 2014. That is our calendar period. So now I am purchasing the subsidiary or I am investing in the subsidiary on 30th September means can I take it as 1st of October? So which means our calculation is easy because after July, August, September, after 3 months only you are purchasing the or you are investing in the whom? Subsidiary. So the subsidiary was acquired, I can say either 30th September or 1st of October. So from September, so this is my period of consolidation I need to take care of, isn't it? Anything before, is it my consolidated period? No. Is that profit is belonging to me? No. So subsidiary also would have operated their business throughout their financial period. However, the profit which is belonging to us is going to be from October to June 2014. Did you understand that? Everyone is clear about that? It is very important. So especially when we are going to do consolidations, the media acquisitions will impact only retained earnings calculations. It will impact only retained earnings calculations when you are preparing your balance sheet. Because retained earnings means that is where the profit is getting impacted. If you know the correct retained earnings, that is the retained earnings, you need to use it in your other calculations. So first you need to determine that. But did you understand this up to this point? Okay. So now I am going to now they are asking us to calculate the goodwill and retained earnings to be included in the consolidated statement of financial position. So in which statement they are asking us to record it? In the consolidated statement of financial position. Right. So in order to determine that, you need to identify what is your pre-acquisition profits and post-acquisition profits. What do you mean by pre-acquisition profits? The profits before you acquire. Post-acquisition means the profits after. So pre means what? Before acquisition. Pre means before acquisition. Post means after acquisition. So after acquisition, how many months that subsidiary is belonging to you? That is belonging to you only 9 months, because from October to June 2014. Did you understand that? So if you calculate from October 1st to June 2014, there will be 9 months. So the period which is not relevant to us is 3 months. July, August and September, these 3 months the profits is not belonging to us because I did not invest in the subsidiary. So can I enjoy those profits? Can I enjoy those profits? No, I can't. Right. So that is the clarification that you need to understand when you are going to adjust for mid-year acquisitions. Right. So now they are asking us to calculate the goodwill. So when you are trying to calculate your goodwill, first you need to understand what is the fair value of consideration. So fair value of consideration means what? How much you are paying to purchase the subsidiary. Right. So how to understand that? They have given, you have paid how much? 530,000 in order to purchase the subsidiary. So this is your fair value of consideration. That is your fair value of consideration. Did you understand that? Because they are telling that Power Stock Company acquired 80% of S Company shares for 530,000. What is the next thing to calculate goodwill? So let's calculate it here. Fair value of consideration You know that that is 530,000. So everyone knows that. What is the next thing? Fair value of non-controlling interest. What is the fair value of non-controlling interest? 140,000. That is also provided to us. What is the next thing? Fair value of net assets. Fair value of net assets at acquisition. So at acquisition, what is your fair value? So that you need to deduct. So how to calculate that? You need to know your share capital. Is there any share premium, revaluation reserves, and retained earnings as of when? On 30th September 2013. Did you understand that? You need to calculate that 30th September 2013. So that is the date you need to take the balances off. So now they are telling that Sherburne's company's share capital on 30th June 2013 was 200,000. Have they given what is the share capital as of 30th June 2013? Yes. That is how much? 200,000. Retained earnings were 360,000. Right. I didn't get you. Which is including? That is what we are going to discuss. Yes, yet we didn't go right. Anything wrong with the share capital? Share capital, everyone understood? Okay. And they are telling that its retained earnings is 360,000. Sherburne Company did not issue any shares for the year ended 30th June 2014. So now they are telling that on 30th June 2013, their share capital was 200,000. But the retained earnings was 360,000. Right. However, continue reading. Yet again they are telling that Sherburne Company made 80,000 worth of profits in the year 30th June 2014. Which means to the financial period up to this date, up to 30th June 2014, they have made a profits of 80,000. How much they have made? Profits of 80,000. Who has made? The subsidiary. So subsidiary has made a profit of 80,000. Of these profits, is it belonging to me entirely? No. Why it is not entirely belonging to me? Why it is not entirely belonging to me? Because we are purchasing, or we are acquiring, or we are investing on subsidiary on 1st of October or 30th September. So it means you need to count from 30th September. So the profits belonging to us is going to be 9 months. The profits not belonging to us is going to be 3 months. So now you need to prorate it. And for this question, you are finding the opening retained earnings or closing retained earnings? You are finding the opening retained earnings or closing retained earnings? Opening retained earnings. So should I take the 9 months or 3 months? Should I take the 9 months calculation or 3 months calculation? 3 months calculation, because that 3 months is belonging to the subsidiary, not belongs to me. So whose retained earnings I am calculating? Subsidiary's retained earnings. So 80,000 is for 12 months. Then what is for 3 months? 80,000 for 12 months period. And what is for 3 months? How much you are getting? You should get 20,000. Are you getting 20,000? Did you get 20,000? Yes. Now, you know that up to 30th June, I'm talking about the retained earnings of subsidiary, okay? Retained earnings of subsidiary. Up to 30th June, it was 360,000. Throughout the period, they have made 80,000. Throughout the period. But we are investing from this date. So any profits during this date is not belonging to us. So this 20,000 also needs to be added back to non-controlling interest profits. So as of 30th June, their retained earnings is going to be 380,000. Their profit is going to be how much? 380,000. Right. So now, do they have any revaluation reserves? No, right? Any share premium? No. So this is going to be 380. So in total it is going to be 580. So fair value of net asset at acquisition is going to be 580. You need to deduct it so that you will get profit of how much? 90. Not profit, actually, it's a goodwill. So your goodwill is how much? $90. Okay. So what you need to understand here, in a mid-year acquisition, you need to understand how to prorate your profits, because certain period is not belonging to the group accounts, certain period it is belonging to the group accounts. So in this instance, the first 3 months is not belonging to us. So those profits you can't take into group calculation. So you need to apportion it and allocate it to what? To non-controlling interests, retained earnings, because non-controlling interest is owning their own company 100% up until when? Up until when? 1st of October 2030. So up until that date, it is not our profit. So we need to see as of 1st of October, what is the retained earnings. But in the question they have given, as of 30th June 2013, it was 360,000. As of June 2013, it was 360,000. So now we are trying to achieve what it was on 1st of October. Okay, right. Did you all try activity 8? Any doubts in this part? Anyone? Right, activity 8, they are asking us to calculate the goodwill, and they are asking us to complete only certain aspects or the extracts of consolidated statement of financial position, not in full, right? What happens to inventory, what happens to trade receivables, retained earnings, non-controlling interest and trade payables. Only these adjustments. Okay, so let's cross check. Okay, let's do it together. Let's read it together now. Guys, let's, in order to practice, guys, listen, you need to note something. Technically, this is how they will test in your computer-based exam for ACCA. They will not ask sometimes the full question for you to do it. Only the adjustments they will ask you to do it. So when they ask for the adjustments, you have to be very careful, because in the full question you know the entire working, how it will impact. But when they are asking us to do from somewhere, then you have to be more sound in your calculations. Okay, right. So in this company, see, so let's do it together. Ponsbury Company acquired 70% of the share capital of Stokesay Company on 1st of April 2013. The share capital of S Company is 1.8 million and P Company offered 50 cents of its shares for every 3 shares in S. The market price of P's company shares is $1.2 and the fair value of non-controlling interest at the date of acquisition is 710,000. And they have given P companies and S companies financial statements extracts, which means your balance sheet extracts. So, and they are telling that on 31st March, S company had goods in inventory. It had purchased from P company for 50,000. P company charges 25% on markup on cost. So, P company had goods in inventory purchased from S company for 100,000, which is a margin of 20%. At the year end, P company stock say for 30,000 of goods that Ponsberry had purchased. So there are 2 transactions where parent is selling to the subsidiary is selling to the parent. No worries, I'm just rushing it through just to see the requirements. And they are telling that profit made by the subsidiary is 150,000. No adjustment has been made to retained earnings or non-controlling interest in terms of intra-group trading. And they are asking us to calculate the goodwill and the balances for the extracts that they have given. Right. The first thing is what? You need to identify whether there is a relationship existing. Whether there is a relationship existing. Whether there is a relationship existing in terms of parent and subsidiary. So the first, what is your working one? Your working one is going to be the group structure. So in your group structure, you know that the P company has invested 70% on S company. How much they have invested? 70%. Guys, listen. So the controlling interest is how much? So you have control over the subsidiary 70%. You have control over the subsidiary 70%. And the non-controlling interest is how much? The non-controlling interest is going to be 30%. Isn't it? Right. So now you are working to. What is your working to? Net assets of subsidiary. So at the acquisition date, how much? And at the reporting date, how much? So you need to understand about the share capital. You need to understand about the share premium. You need to understand about the revaluation reserves and retained earnings. Okay. So the share capital of S company is how much at the beginning? 1.8 million. So that is 1.8 million at the beginning. And at the reporting date is also it's going to be the same. Then they have not given us the share premium or no any revaluation reserves. So no issues. And you need to understand what is your retained earnings. Okay. So what is the retained earnings for the period? That is provided. The extract of statement of financial position of 2 companies is given, and on 31st March 2014 are as follows. So their retained earnings of S company, this is on 31st March 2014. Is it your acquisition period or reporting period? Everyone, reporting period. So that needs to be 1420. Am I correct? So what is the retained earnings at the start? Have they given? What is the retained earnings for the period? Anyone? What did you say? 420? They have given you 150,000 as the profits of the subsidiary for the period 31st March 2040. So that is for the year only, for your financial period. But you need to find your opening retained earnings. So they are telling that your closing retained earnings is 1420. Am I correct? So profit for the period is 150. So the opening retained earnings is going to be 1420 minus 150 is how much? 1270. So your opening retained earnings is going to be 1270. Okay. So now your working 3. Don't finalize your working 2. Working 3. What is your working 3? You need to calculate your goodwill. Right. So how to calculate your goodwill? Fair value of consideration. Then fair value of non-controlling interest, and reduce fair value of net assets at acquisition or reporting? At acquisition. Right. So now you need to find the fair value of consideration. Have they given the fair value of consideration? No. So in order to find the fair value of consideration, they are telling that P company acquired 70% of S company on 1st of April 2013. The share capital of S company was 1.8 million and P company offered 50 cents of its shares for every 3 shares S company hold. So S company is having 1,800 or 1.8 million worth of shares. For every 3, I am paying them 5 of my shares. Every 3 shares of them is equals to 5 of my shares. Then at a price of $1.2. Always you need to take the market value. At the price of $1.2. So that is how much? 3270. The entire total after calculation. 3.6 million. 3.6. Is that correct? 3,600? Okay, good. So this 3,600 is the total value of the shares. Of this, we are investing how much? Only 70%. So for this you are investing how much? 70%, because 70% is your investment, isn't it? Only 70% you are purchasing. So they are telling that of 1.8 million, for every 3 shares of them is equals to 5 shares of us. So we took the total value of the company. You got it? So what is the value here? 2,520. So this is your controlling interest, and also you can find your non-controlling interest. 3,600 minus 2,520 is how much? It's okay. 1,000? Okay, we are just calculating here. How much is that? 3,600 minus 2,520. 1,000? 80. So non-controlling interest, what they have given? They have given at the date of acquisition was 710. What could be the difference? I'm just asking a question. You don't want to go this standard. But here see, I am purchasing 70% of your company. Then 30% is belonging to you, no? Isn't it? So if you say 70% is 2,520 out of 3,600, then the remaining is non-controlling interest portion. So that needs to be their fair value, right? In terms of non-controlling interest is not provided, that is what you need to take. Did you understand that? In this question, they have made some adjustments, some other deductions, which means there can be some revaluation losses. So those things are not provided to us. So in a question where if examiner is not giving you the fair value of non-controlling interest, you can take this. You got it? At this point you don't want it, because at this point you are going to calculate what is your fair value of consideration, how much you are paying them. Okay? Alright. But I'll match this 1080 in later while. But just hold on for that. So now the fair value of consideration is how much? 2,520. Am I correct? Did you understand how did I arrived at 2,520? So 1.8 million worth of shares. So every 3 of them is equals to 5. So my share value is $1.2 and I am purchasing only 70% of it. So that is 2,520. Then fair value of non-controlling interest is 710. Fair value of net asset at acquisition, let's calculate it. We need to calculate it. Yet we didn't do it. Leave it there. We'll come back. And then you will arrive at your goodwill. The question they are asking the non-controlling interest as well. So I need to do the working. My working for is non-controlling interest. To calculate your non-controlling interest, you need to take fair value of non-controlling interest. That is how much? 710. Then post-acquisition reserves. Post-acquisition reserves. So at the reporting date minus at the acquisition date, sorry guys, into 30%. So we need to find the reporting date and acquisition date profits, which is our working to. Yet we did not finalize our working to. Then working 5. Group retained earnings. So you need to take equity of the parent. Equity or retained earnings? Retained earnings. Good. Not equity, you need to take the retained earnings of the parent and reporting date minus acquisition date into 70% that you need to take. Adding it to. That is your post-acquisition reserves, right? The difference between reporting and acquisition date is your post-acquisition reserves. After purchasing, what is your reserves? Post-acquisition. So at the reporting date this much, at the acquisition date this much. So the difference between them will be your post-acquisition. Right. Why didn't I finalize my working to? Because there are some adjustments to do. What are those adjustments? Especially this part of your calculation. Okay. This is very important. Those who did not understand, certain areas yesterday? Please check now. So on 31st March 2014, S company had goods in inventory that it had purchased from P company. So which means who has sold to whom? Parent has sold goods to subsidiary. Parent had sold goods to subsidiary. So for how much they are selling? So they have sold 50,000 worth of goods. So P company charges 25% markup on cost. They are charging 25% markup on cost. So P company had goods in inventory purchased. Okay, from there it is the second purchase. Okay, so from this 50,000, what you are trying to identify? The goods is balance remaining in the inventory. Whenever you hear this word, you need to calculate unrealized profits. You need to calculate what? Unrealized profits. This is what I told you yesterday. So goods are remaining in the inventory. So then for the goods remaining in the inventory, always you need to calculate the unrealized profits. Right. So now your cost plus profit is equals to selling price. You know that equation. Markup means your cost is 100%. So your profit is 25%. So your selling price is going to be 125%. This 50,000 is your selling price or your cost. How did you decide it? Because that is in the inventory of S company. In the inventory of S company means that is the purchase price. So purchase price is before charging the profits or after charging the profits? After charging the profits. With the profits only you will sell. Otherwise they will tell the cost is this much. Okay. In this question this 50,000 is your sales price. That is how I am confirming myself it is my sales price. So 50,000 is your sales price divided by the sales percentage. Sales needs to be divided by sales percentage. So that is 125. Now you are trying to identify what is your unrealized profits out of this. That is 25%. So what is that? 10,000. So you are getting $10,000 as unrealized profits. Now in this case, who is selling to whom? Parent is selling to the subsidiary. Then what is the double entry? Your closing inventory account credit by 10,000. Then parents or group retained earnings account debit by 10,000. Yesterday you were asking me, right? We had to adjust this. So the 10,000 will be deducted from your inventory balance. I'm just marking for my safety. And then the 10,000 needs to be reduced here as unrealized profits 10,000. Did you understand that? Because parent is selling to the subsidiary. If parent is selling to the subsidiary, what will happen? In your group retained earnings, you need to reduce it, and your inventory balance also should go down. Okay, understood up to this point? Right. The next one, there are two adjustments there. So then P company, which is the parent company, had goods in inventory. Now parent company is also having some goods in inventory purchased from S company for 100,000. So this time who has sold? Subsidiary has sold goods to parent. So how much is the goods remaining? 100,000. So for a profit margin of 20%. So this time they are using profit margin. So cost plus profit is equals to selling price. So if they are using margin means your selling price is 100%. So your profit is 20%. So your cost is 80%. So this is my selling price. This 100,000 is my selling price. So this 100,000 is remaining in the inventory. So I need to calculate the unrealized profits for this 100,000. So which is divided by 100 into 20. Am I correct? Yes. So which is 20,000. This is 20,000. So what is this 20,000? This 20,000 is your unrealized profits. So in this instance you are doing all my workings. You are doing all my workings. So what is the double entry? Anyways your inventory is going to get credited. You need to reduce your inventory. That is sitting here. You need to deduct 20,000 from here. Okay. Then your working to, which is net assets of subsidiary, needs to be removed by how much? 20,000. So if you are following my method of calculating all the workings, this is all you need to do. If not, you need to do a split between the non-controlling interest and the group retained earnings. So we did a question like that yesterday. So in this instance, you need to reduce your unrealized profits. Your unrealized profits that is only at reporting period 20,000. So you need to reduce how much? 20,000 from these profits. That's all our adjustments are, isn't it? Do we have any more adjustments? No, we have. What is it? The last part of the adjustment is they are telling that, listen to this part. At the year end, P company owed S company 30,000 for the goods that P company had purchased, which means that is the intra-group sales. That is your intra-group sales, your remaining amount of goods for which you are still owing. If you are still owing means that balances will be stuck in receivables and payables account. So I told you if there are any amounts remaining, you need to remove from your group accounts. So in your group accounts, you can't take any intra-group sales, it needs to be eliminated. So which means your receivable balance needs to be reduced by 30,000 and your payable balance also needs to be reduced by 30,000. This is why examiner is asking you inventory, receivables, retained earnings, non-controlling interest, trade payables. So this is where all the adjustments will impact. And also the goodwill. It will impact the goodwill also. Because according to my calculation, without working to, you can't do anything else. So I need to make sure I do it correctly. Right. So now we are done. Now I am going to finalize my answers. So what is the total here? 1,800, 3,070. Here you will get 3,200. Okay. So fair value of net asset at acquisition is how much? 3,070. So what is your goodwill? 160. Everyone gets 160? Right. So check. They are also getting 160. Then fair value of non-controlling interest you need to calculate. At the reporting period you had 3,200. At the acquisition period you had 3,070 into 30% is how much? How much? 39. So your total non-controlling interest is 749. Is that correct? So your total non-controlling interest is going to be 749. Your group retained earnings. I need to take the retained earnings of the parent. That has been given, right? That is 5,470. So 5,470. Then reporting date it was 3,200 minus 3,070 into 70%. How much is that? 90. 91. So what is the closing balance you are getting? 5,551. So your retained earnings, this is your group retained earnings, that needs to be 5,551. And then when you adjust your inventory, so 750 plus 240 minus 10 minus 20, you should get 960. Are you getting 960? Receivables you should get 830. We got this, we got this. Did you understand that? Does it make sense? Now see how important is your 5 workings. So if you properly do it, it's easy. All the questions, yes, it takes little time, but once you practice it, you know what needs to be entered where. And the maximum confusion that examiner can give you on unrealized profits is this at your level. If there are any remaining inventory, that is an indication for you to calculate your unrealized profits. And also see whether the parent or the subsidiary is owing each other. Owing each other means there are some credit transactions. So that needs to be removed from your receivables and payables. Understood? So in terms of media acquisitions, you need to make sure you need to prorate your profits. You got it? You need to prorate your profits. Is that clear up to this point? Any doubts in this question? Any doubts in this question, guys? Anyone? No, right? Right, now can you try activity 9 and activity 10 you can do at home. Try activity 9. You already did activity 9? No, right? I didn't ask you to do it. Shall we discuss? Or you all need 5 minutes? I can give you. See, P company acquired 80% of the share capital of S company on 30th September 2010. The accounting year end for both companies is 31st December. P company exchanged one share in P company plus a cash payment of 30 cents for one share in S. On 30th September 2010, the price of P company's share was $1.5. S company's share capital throughout 2010 was 2 million and its profit for the year is 280,000. So profit for the period is how much? 280,000. The fair value of S company land and building was 250,000 more than the value shown in the S company's accounting records. So more than the accounting record is 250,000 plus. Okay. The fair value of non-controlling interest is 810,000. So P companies and S companies financial statements are given. Have they given any other adjustments? No. Those are the adjustments that you need to compute. So in your working one, you understand the group structure. So P company is your parent, S company is your subsidiary. So the controlling interest is 80% and the non-controlling interest is how much? 20%. First you need to identify that. Is it a fully acquisition or a mid-year acquisition? It's a mid-year acquisition. That also you need to understand, it is a mid-year acquisition. When are you purchasing this company? When are you investing on this company? P company acquired 80% of the share capital on 30th September, which means from October to December only your period, isn't it? 30th September 2010. So which means 3 months is post acquisition periods, 9 months is pre acquisition periods. So your pre-acquisition period and your post-acquisition period is going to be 3 months post, 9 months before. Only 3 months is belonging to our group, but 9 months is at the beginning. Okay? Right. Now, let's see why did I get that information for. So when I am computing my net assets for subsidiary, that is my working two. When I am computing the net assets for subsidiary, I need to take the share capital. So share capital is how much they have given it as 2 million for the subsidiary. So it needs to be the same at the reporting date and at the acquisition date. No any share premium given, so no worries. Have they given revaluation surplus? Yes, they have given. So this revaluation surplus will increase by 250,000. So you need to compute that 250,000 at the reporting date and at the acquisition date. And also, don't forget, to your tangible non-current assets, it will increase by 250,000. The assets value will increase by 250,000. Okay? When you are making your group accounts, otherwise your group accounts won't tally. Okay, fine. Then retained earnings. You need to calculate your retained earnings. In this question, there won't be any unrealized profits because they are not holding any inventories, no any intra-group sales, so no issues. However, you need to find your retained earnings. To find your retained earnings, you need to get the retained earnings at the reporting date as well as the retained earnings at the acquisition date. So reporting date you can directly get, it is 1370. So you can directly take it as 1370. But at the acquisition date, can you take it directly? No. So for the acquisition date, now see, you are making the profit for the period is 280,000. So closing retained earnings was 1370. Of this, 9 months profit is not related to us. So what is that 9 months profit? 280,000 divided by how many months? 12 months multiplied by 9 months. So you are arriving at how much? How much is that difference? How much? 210. So $210 should be the post-acquisition profits. 210 should be the post-acquisition profits. Sorry, pre-acquisition profits. Then post-acquisition profits needs to be from 280 minus how much? 70. Sorry, 210 will be 70. So profit which is belonging to us is going to be only 70. Isn't it? So the profits belonging to us is going to be only 70. So as of this period, so the opening retained earnings for us is going to be 1,300. Did you understand that? Because for these 3 months, the relevant profit for the group is going to be 70. From this, if you deduct this, you will arrive at the profits after 9 months. The total retained earnings after 9 months. So that is how we are arriving at the retained earnings at acquisition. Retained earnings at acquisition. Yet again, I'll explain you. You didn't purchase it from the beginning. For 9 months, profit is not relevant to us. This 210 is not belonging to us. Only 70 is belonging to us. Closing is given. So from closing, whatever the profits belonging to you, if you deduct, you will get the opening retained earnings. Simple as that. Right. So we are done with our working 2. Now you need to finalize your working 3. So in order to finalize your working 3, you need to know what is your fair value of consideration. So they are telling that when you are purchasing the peak S company, okay, for how much you are purchasing? 80% you are investing. So now you need to know how much you have paid in order to purchase, which means invest in that company, how much you have made. So they are telling that P company exchange one share in P plus a cash payment of 30 cents for one share in S. So that I have done a calculation here. So in terms of cash, you had 2 million worth of shares, isn't it? You had 2 million worth of shares. 80% you are purchasing in the subsidiary. Subsidiary had how much? 2 million worth of shares. Of that, 80% you are purchasing for 30 cents, isn't it? So that will be 480,000. That will be how much? The cash that you are going to pay is 480,000. That is the consideration paid. Is it the total consideration paid? No. Other portion is you are bearing it by what? You are bearing it by shares. So first you need to understand there are 2000 shares. For every 2000, every one of you are exchanging with one of him at a price of 1.5. Of this, 80% is belonging to you, isn't it? So 80% of that is how much? 2,400. So when you simplify this, you should get 2,400. Okay. So the total consideration paid will be 2,880. So you are paying 400 by cash, 480 by cash, and 2,400 by shares. Did you understand that? 480 by cash and 2,400 by shares. So the total consideration is going to be 2,880. Fair value of non-controlling interest they have given, so that is 810. And then the fair value of net asset at acquisition we have calculated, that is 3,550. So if you deduct it, you will arrive at 140. That is your goodwill. That is your goodwill. 140 is your goodwill. Then you need to calculate your non-controlling interest. That is easy. Fair value is given, and post acquisition reserves you can take it, right? At the reporting date this is this much, at the acquisition date into 20%. That is 824. Then when you take the group retained earnings, you take the group profits. So parents retained earnings you take it. That is 14,570. Then calculate the reserves at the reporting date and at the acquisition date at 80%. So that will be 56. So you will get 14,626. You are done with all your workings. Now it's easy for you. You have to just balance your consolidations. You need to prepare your group accounts now. So when you are preparing your group accounts, you need to total all the tangible non-current assets. So what's the total of all tangible non-current assets? So let me total here. 18,740 plus 3,110 plus 250 is going to be 22,100. Can I take investment in subsidiary? No, I need to take goodwill. So goodwill is by working 3, that is how much? 140. You need to take only 140. Then current assets, because in group's point of view, the investment in subsidiary is what? Is the same investment in their own company. So same investment in their own company, can you show in the groups? No. Total current assets 3,320 plus 640, which is 3,960. So then you will get a total of 26,200. The same total you need to get here as 26,200. Let's check. Share capital. You need to take only parent share capital. So that is going to be 6,600. Share premium, only parents, 1280. Only parent you need to take. Then retained earnings, that is our working 5. that is how much? 14,626. Then you need to take your working for non-controlling interest, that is 824. Then finally you need to add back all your current liabilities. So current liabilities is 2,490 plus 380, that is 2,870. 2,870. So when you total up, are you getting 26,200? You need to meet at 26,200. So consolidated part is easy. The thing is, you need to know your workings. So these are the adjustments that examiner can ask you. Okay. You didn't understand what adjustment? Profit for what? Media acquisitions. Media acquisitions profits. The opening and closing. Okay. So in this case, you are purchasing your company. Now this is your financial period, right? 31st December. So which means your financial period, it is not writing. Your financial period is from January to December. But you are purchasing the company at this point, which is 30th September or 1st of October, isn't it? So they are telling that your closing retained earnings is 1,000, how much? 300 and something, 370. Okay. Throughout the period, you have made a profit of 280. For the, see, profit for the year is 280,000. So to the entire period, you have made 280,000. So this 280,000 is for this entire period. But for my group, I am investing on October. So whatever the profits before acquisition is not related to me. I need to see what is the profit at this point. What is the profit at this point? So I know what is at last. So at the closing, I know it is 1,370. So which means I need to know on October how much was the total. So in order to identify that, you need to find how many months are here. So October to December, there are 3 months. So from 280,000, where this profit is for 12 months, I need to take for 3 months. So profit for the period is going to be 70,000. So the profit which is related to 3 months is going to be 70. So when you go backwards, positive figures needs to be deducted. So this will be 1,300. So as of this period, my profit is going to be 1,300. So if I ask what is the profit at January, 1,370 minus 280. So that will be 1,090. Did you understand that? But I want what is the profit at this period. So throughout the period you are making 280,000, but I need to know as of October how much, because that is my acquisition period. So to arrive at that October profit only, I am getting the help of this, and I am prorating how many months back I need to go to see the profit at this point. Okay. So to see the profit at that point, you need to take only 3 months. Did you understand that? Is that clear to you now? Fine. Now you can work out activity 10 at home now. That will be your homework. So you can practice and see whether you are balancing. No worries. You can cross check your answers as well. Better use all those 5 workings so that you get a good grip of understanding what you are trying to do. Okay, so that's all about consolidated statement of financial position. Shall we do a small summary? The adjustments that we are supposed to look into, because next the consolidated statement of profit or loss that we are going to discuss. Right. However, you all help me to do it. So now we have discussed consolidated right. So now we are discussing the consolidated statement of financial position. So guys, in order to consolidate any accounts, what are the rules that we learn? The first ruling is what? You need to add your assets and your liabilities. Is it? Should you do it? So when you are consolidating, the first thing that you need to do is you need to add your assets and liabilities. The second thing is what? What's the second point? You need to calculate your goodwill. This calculation of goodwill in your balance sheet, it will replace the investment made only at subsidiary, okay, not the entire investment. Sometimes in the exam question, examiner can give you investments 500,000. Of that he can say 50% is investment on subsidiary, 50% other investments. So are you going to remove or replace the entire investments? No. In that situation, you need to make sure that 50% of investment that you have made on other companies or other assets, that needs to be shown in your statement of financial position. Only the investment in subsidiary needs to be replaced by goodwill. Did you understand that? Only replace the goodwill, balance sheet replace the investment only on, I'll make the word that, subsidiary. Only the investment which you are making on subsidiary, you need to replace it. Third point, you need to take only whose capital? Only parent's equity. So when you are taking your equity, consolidating your equity, will you add the equities? No. We will not add the equity part. Only parent's equity will take. Just go through all the questions we did and see have we done that part. Fourth one, you need to calculate your non-controlling interest. Fifth part, you need to calculate your group retained earnings. Okay. So these are the conditions or rules. Then we also learn workings. Our workings are very important. So working 1, you need to understand the group structure. Working 2, you need to understand the net assets of subsidiary. Working 3, goodwill. Working 4, non-controlling interest. Working 5, group retained earnings. So these are the workings that you need to do. Then the next part is adjustments. So when it comes to adjustments, first you need to understand the fair value of considerations, which means your goodwill calculation. So in fair value of consideration, you can either buy at paying cash or by paying shares. It's very important. Another adjustment is intra-group sales. So in the intra-group sales, you need to consider only credit transactions, because only the credit transactions will form a receivable and a payable, right? Then if inventories left through intra-group trading, then what you need to do? You need to calculate unrealized profits. You need to calculate unrealized profits. So unrealized profits, be very careful. Who is selling to whom? Is it parent selling to the subsidiary, or subsidiary is selling to the parent? Then you know what are the adjustments you need to do there. Then mid-year acquisitions. So mid-year acquisitions will only impact your retained earnings in balance sheet. Will only impact your retained earnings. Everything else is going to be the same, even at the mid-year acquisition period. So if you focus on these adjustments well, and if you are thorough with these adjustments and what you need to do on all these occasions, practice questions on these areas. I have already told you these are the adjustments, and these are the adjustments examiner will test from you. Not anything beyond this. You got it? So that is your consolidated statement of financial position. Right. Right, now we are going to consolidate a profit and loss statement. Okay, we are going to consolidate a profit and loss statement. So see here, so in consolidation of P&L is also the same thing. So you take the P&L of your parent company, you take the P&L of your subsidiary company, and you are going to merge each other. Okay. However, when you are allocating the profits of subsidiary, you need to allocate it separately to your equity. Equity means your parent and your non-controlling interest. So when you are dealing with profit and loss, you will also come across unrealized profits, because unrealized profits will hit your inventories as well as what? Where else it will impact? Your profit shares. Okay, and also intra-group sales, the receivables and the cost of sale. Now see, for you it will be a receivable, for me it will be a cost of sale. So that also will be an adjustment in statement of profit or loss. So those are the first three adjustments we are going to see along with mid-year acquisition. So those adjustments will also come in terms of P&L. So when you are consolidating a P&L, let's see how we are going to do a consolidation. Right. So technically, if you take this as a consolidated P&L, which means already the consolidation is done. Two companies merged and their profits, revenue is this much, cost of sales, gross profit up to profit for the period is given. So now you need to understand how to distribute or attributable, which means how to distribute your profits. So your profits is distributed among your owners and the non-controlling interest, which means your equity holders and non-controlling interest. So let's see how we are going to do that. Now see this example, let's do it together. This is an example question. P company acquired 80%. How much they are acquiring? 80% of the share capital of S company on 1st of January 2017. There was no intra-group trading. There is no any intra-group trading. P company and S company has a statement of profit or loss as of 31st December 2017, which means is it a full year acquisition or a mid-year acquisition? It's a full year acquisition. So here also you need to identify your group structure. So you understood P is purchasing at S 80%. So now you are supposed to do the consolidations. So when you are consolidating, see P companies and S company. So I need to prepare the group structure. The group accounts. So when I am preparing the group accounts, I need to add both the revenues. So if I add both the revenues, shall we add together? So it is 8,170 plus 1,230, that is 9,400. Then you need to add the cost of sales together. So that is how much? 6,120 plus 810, that is 6,930. So which means your gross profit is going to be 9,400 minus 6,930. It's going to be 2,470. Then you have other operating expenses, add it. That is 890 plus 250. So that is 1,140. Then you need to have your taxes. So you will arrive at the profit before taxes. So which means 2,470 minus 1,140, which is 1,330. From that you need to add back your tax expenses, 270 plus 40, so it will be 310. So now in the group profit, how much you are making? 1,330 minus 310 is 1,020. Now this is the group profit. This is the group profit. Okay. So up to this point, no issues. So now you need to attribute your profits or distribute your profits. So when you are distributing your profits, be very careful. I'll do it in this side. So I'll say distribution of your profits. You need to distribute between your parent and subsidiary. So parent is your equity holder and subsidiary is your non-controlling interest. So guys, for parent, entire their profit is belonging to them, isn't it? Will they share that 890? No, that is completely belonging to them. So that is 890. Parent's profit 100% is belonging to the parent. But subsidiary's profit of 130, 80% is belonging to us, 20% is belonging to them. So of this 130, 80% is my share, isn't it? Then for non-controlling interest of that 130, they will get only 20%. Okay. So what is this? 130 is 80% is how much? 104 plus 890. So the total profit here is 994. So this is the total profit which parent will take home, and then 130 into 20%, that is 26. So only 26,000 worth of profits that non-controlling interest will take home. Did you understand that? So now when you total these two, that is 1020. That is the group profit. Shall I explain it again? So when you are distributing your profits, your parent profit is 100% belonging to the parent, not anyone else. Because will I share my profits without anyone investing? Now let's say I am investing in my company and I am earning 890. Will I give it to you? I won't give it to you. Now let's assume in your company I am investing 80%. So which means I have invested 80%. 80% of your profits is belonging to me. Only 20% of those profits is belonging to you. So of this 130,000, 80% is belonging to me. So my total profits from the group I am going to get 994. But the subsidiary is only going to get 20% because that is their investment. So their investment is only 20%. So of that 130, I will give them only 20% to enjoy. Did you understand that? Did you understand the distribution of profits? Good. So that is what they are telling here. Profits attributable to equity owners and non-controlling interest. So the parent we call it as equity owners because in exam questions, examiner can use these words. What is the profit attributable to equity owners? So equity owners means what? Parents. Non-controlling interest is your subsidiary. Okay. So now, can you try activity level? So you should get revenue as 9,220 when you sum up those two. Cost of sales as 5,610. Then your gross profit will be 3,610. Then this is your operating expenses total. So you will arrive at profit before tax and you deduct your taxes and you will come at the group profit. So now you need to distribute your group profit. So when you are distributing your group profit, you need to distribute it between equity owners and non-controlling interest. So to equity owners, this 1038 is formed. You need to take 750. This entire 750 is belonging to them. And why it is not writing? Entire 750 is belonging to them. So which means that 750 plus the share that they have invested on subsidiaries profits. So subsidiary they have invested 60%. So of this 480 they will enjoy 60%. So when you total this you will get 1038 and subsidiary or the non-controlling interest will bear the rest 40%. So 480 is 40% is going to be 192. That is how the group profit is being distributed. Did you understand that? Everyone? Did you understand that distribution part? That is important here. Okay. Because that can be questions. Now we are going to see the adjustments part. So same adjustment which is intra-group trading. So you all know the understanding of intra-group tradings, right? What is intra-group trading? Is there any sales or purchases between, or is there any trading between the parent and the subsidiary? If you find any trading between them, you need to eliminate them. So when you are eliminating in terms of intra-group tradings, you need to reduce your revenue and you need to reduce your cost of sales. You need to reduce your revenue and cost of sales. Okay. So let's see those things through questions and then we'll come back to these points. So it will make more sense then. Then, if there are any closing inventories remaining, what you need to do? You need to calculate unrealized profits. You know what unrealized profits, right? So if any inventories are remaining, you already know. So if you see in these terms in your questions, you yourself should say, I need to calculate in unrealized profits. You got it? So don't forget that. That's very important. So now when you are calculating your unrealized profits, you need to increase your cost of sales. Reduce your cost of sales, debit your cost of sales, and credit your inventory. So that's the double entry for that. Then, who is selling to whom will be another concept. Is parent has sold goods to subsidiary, then in terms of unrealized profits, how am I going to adjust it? If parent has sold goods to subsidiary, the unrealized profits, anyways you need to deduct at cost of sales. Apart from that, when you are distributing profits, to the equity holders, you know equity holders, right? You know who are equity holders? Equity owners is what? Parent. So in the parent's profits, you need to deduct the unrealized profits. In the parents, I'll get you. Yeah. So if parent is selling to the subsidiary, who is selling? Parent is selling to the subsidiary, and if goods are remaining, you need to calculate the unrealized profits. Once you calculate that unrealized profits, deduct that cost of sales, okay, and deduct that equity holders profit distribution. So here you calculate a profit distribution, right? So here you deduct that unrealized profits. You got it? So when you are distributing the profits to equity owners, you need to deduct the unrealized profits if parent is selling to the subsidiary. Understood? Right. The next situation. The next situation is if subsidiary is selling to the parent. If subsidiary is selling to the parent, yet again, you need to deduct at your cost of sales. You need to deduct at your cost of sales, and the profits also needs to be adjusted, wherefore equity holders and non-controlling interest at their percentage. For an example, let's assume if your unrealized profits is X into, let's assume 80% is equity holders needs to be deducted. You need to deduct 80%. From non-controlling interest, unrealized profits into 20%. It depends on the ratio that they are giving. I am just taking 80%. If subsidiary is selling, cost of sales also you need to deduct it. But when you are going to distribute or deducting the profits, parents' portion needs to be deducted from parents' equity, and subsidiary's portion needs to be deducted at subsidiary. So that is the only confusion that you will have. It's not a confusion, I shouldn't use the word confusion. So that is the only split that you need to do there. You need to derive who is selling to whom. If parent is selling, this division is not required. If subsidiary is selling, then that division is required. Okay. Then little bit of dividends. Dividend paid from subsidiary to parent. So who is paying this dividends? Subsidiary to parent. So let's see what they are talking about there. The parent acquires the subsidiary by purchasing the majority subsidiary's ordinary shares. So this may result parent owners being paid dividends. So of course, right? So we buy their ordinary shares, so we will get dividends. So when you are getting dividends, so in our individual P&L, it's another income for us, right? Investment income is another income to the organization. So in my P&L, the dividends paid are recorded, isn't it? However, as per IFRS 10 consolidated financial statements, the dividend paid from the subsidiary to the parent must be removed when preparing the consolidated P&L. It's a very important point. So I am investing in the ordinary shares of the subsidiary. I am investing in the ordinary shares of the subsidiary. Listen here and then you clarify your doubts. So if I invest in my ordinary shares of my subsidiary, let's assume I have invested around 70%. So 70% of the ordinary shares is belonging to me. Then only I will have controlling interest. To have the controlling interest of the another company, I have to invest on the ordinary shares. Can you invest on preference shares and get control? No. So now I know that I will receive for this 70% of investment, I need to receive dividends. My subsidiary will pay dividends. So I will record that dividends in my P&L. Other income account credit, cash account debit. Now let's assume when you are preparing your consolidated statement of profit or loss, you will add things together, right? So on the other income, if you see dividends that you have received from the subsidiary, you should eliminate it. You should not consider. If you have received any other dividends, perfect, you can consider. But the dividends that you are receiving from the subsidiary, you could not take into consideration when you are preparing your consolidated statement of profit or loss. Did you understand that? Is that clear? What confuses you? Anyone confused? If I invest on your ordinary shares, you need to pay dividends, no? I didn't get you. The profit distribution, how much you should earn, how much you enjoy of that profits. Okay, dividend paid is something else. Dividend payment is must? No. This dividend is the amount that you will receive or you might not receive. Actual profits, how much you have received. That is the allocation, no? In a P&L, whatever the profits that you see, it's just an allocation. Are you actually receiving those profits? Can I actually pay those profits? Non-cash items are there. $190. Yes. So now, the double entry for dividend is what? Other dividend income account debit when you are removing it, and your retained earnings account credit. So you need to remove it from the retained earnings. So that's what they are saying that. Okay. So when you are removing it, whatever the dividend paid of the subsidiary needs to be removed. The dividend paid by the subsidiary needs to be removed. So when you are removing it, already there is an income sitting in the income account. So that will be debited. Removing means you need to minus it. Okay. Then dividends which are paid out through retained earnings, there is a reversal to this same account, which is you are crediting it back to the retained earnings account. So let's see the example 12. Right, let's discuss this. The following figures have been taken from accounting records of P Group for the year ended 31st March 2018. P company purchased 75%. How much they are purchasing? 75%. Of the share capital of S company on 1st of April 2017. Okay, right. So then they have given the revenue, cost of sales, and profit for the period. So these are the three items that they have given. Then, who is parent here? Who is the parent? P company is the parent, and S company is your subsidiary. So parent company has invested 75%. They have invested how much? How much? 75%. Okay. Now let's see. They have given some adjustments to us. First listen to these adjustments, how we are going to do it. During the year 31st March 2018, P company purchased goods for 120,000. How much they are purchasing? 120,000 from S company. So P company has purchased 120,000 worth of goods from S company, and 40,000 of these goods are remaining in the inventory as of 31st March. S company's profit is charged based on markup 25%. Okay. So now tell me, who has sold to whom? Parent has sold to the subsidiary, or subsidiary has sold to the parent? Everyone understood, sir? Awesome. So S, I hate this. So S has sold goods to parent. So when you are selling goods to parent, the first thing that you need to understand, subsidiary has sold goods to the parent. So first you need to understand, is there any unrealized profits? So do you have any unrealized profits? Yes, you have unrealized profits. How much? 40,000 is remaining in the inventory. So unrealized profits you need to find within this 40,000, and they are telling that they are using the cost plus profit is equals to selling price. So they are using markup. So if they are using markup, your cost is going to be 100% and your profit is 25 and your selling price is 125. So which means 40,000 worth of sales is divided by 125% multiplied by 25, because I need to get the profits. So which means, which is 8,000. So my unrealized profits is 8,000. This is your unrealized profit. So this unrealized profit needs to have few adjustments. One adjustment, you need to reduce your cost of sales. Need to reduce your cost of sales. Then for equity holders, this 8,000 will be splitted into 75%. Why? Because subsidiary is selling to the parent. So then you need to split the unrealized profits among the parent and the non-controlling interest. Then the non-controlling interest part, you need to take 8,000 into 25%. So this needs to be a deduction in all the cases. This needs to be a deduction. Let's see how we are going to deduct it. Right. So next. So this 120,000 worth of goods, have they paid? Have they paid? Have they paid this 120,000 worth of goods? They have not paid. So they are silent. Right. So in this situation, you need to remove 120,000 from your revenue anyways. Okay, and 120,000 from your cost of sales anyways. Whether you pay or not, you need to remove this time, because both cash and credit sales between the entities will be recorded in the revenue and cost of sales. So however, if you have sold 120,000 worth of goods, it will be recorded in the revenue. Is it cash sales? They will record. Is it credit sales? They will record. So here you are not going to take the knowledge of receivables and payables, because it is not your balance sheet. It is your P&L. Cash sales you don't record in the P&L, then where do you record it? But it will be still recorded in the receivables. Sorry, revenue. It will be recorded in the revenue. So here I am reducing your revenue and cost of sales, not receivables and payables. Deduct it. In P&L, irrespective of cash or credit sales, you need to deduct it. Because it is sitting in your revenue and cost of sales. Okay? Because the revenue that you are making of this 120,000 from your own sale. Because when you are trading between the group, it is you are selling to yourself. So that is literally recording the revenue and the cost of sales. So it will automatically nullify it. So you need to remove that. So technically remember, when there is an intra-group sales, remove it. Okay. Then to the cash. The cash we are taking only the parents, no? We are taking the cash, we are taking only the parents' cash. Okay. You are asking in the terms of balance sheet or in terms of PM or balance sheet? No, you will take only the parents' cash figure. No, that will be stacking when there is receivables and payables, right? There won't be any, because you are already reducing from your revenues and cost of sales. You got it? So that revenue and cost of sales won't be included in your cash. Okay, fine. So next thing, you had unrealized profits of 8,000. That 8,000 needs to be added back to your cost of sales. You need to add back your cost of sales, because technically cost of sales is a negative figure, right? So if you want to increase the negative figure, you need reduce the negative figure, means you need to add back. Okay, that is mathematical operations there. Then the next one, S company the second adjustment I'm talking about, purchase goods for $300,000 from P company and had 80,000 of these goods in the inventory, and they are using margin 20%. Okay, so now who has sold to whom? Parent has sold goods to subsidiary. So in this situation, do you have any unrealized profits? Yes. Anyways, this 300,000 needs to be adjusted, because that 300,000 is an intra-group sale. I will reduce it from my revenue and I will reduce it from my cost of sales. I need to reduce it from my revenue and cost of sales. Let's do that. Intra-group sales, deduct it. Unrealized profits to the cost of sales, add it. Okay. But unrealized profit we need to adjust when we are distributing the profits also. So keep it in the mind. At the moment I can't do it because we need to finalize the accounts. So here the unrealized profits you need to calculate for 80,000. Isn't it? So they are using margin. So your cost plus profit is equals to your selling price. So if they are using margin, your cost selling price is going to be 100%. And they are using 20% profit, so your cost is going to be 80. So which means this 80,000 is divided by 100 into 20. So how much is that? 16,000. So this 16,000 is your unrealized profits. So without any fear, add back to your cost of sales 16,000. So what should be the double entry for this? Your cost of sales debited, because you are reducing it, and your equity holders share of profits, you need to reduce it by 16,000. Will you do a split between the parent and the subsidiary this time? No, you are not going to do it. Okay, right. So now what you need to do, just next step, now we are going to finalize our accounts. So when you are finalizing our accounts, so you know that the revenue, I'll do the group in this side. Okay. So when you are preparing the group, the total revenue is going to be, for parent is making 5,740 and subsidiary is making 3,120. Of that, these two have traded 120. Sorry, I missed the calculation. Hold on. These two are trading 120 among them and 300 worth of sales among them. So the total revenue is going to be 8,440. Okay. You need to remove your intra-group sales. Then the cost of sales, 3,030 for the parent. For the subsidiary, they are making 1,450. And intra-group sales of 120, you need to reduce it, as well as 300 you need to reduce it, and add back 16 of unrealized profits and add back 8 of unrealized profits. So it's going to be 4,084. So your group profit is going to be how much? Your group profit is going to be 8,440 minus 4,084. It needs to be 4,356. 4,356. Now you need to distribute your profits. So when you are going to distribute your profits, let's see, for equity holders or equity owners and non-controlling interest, how much they are sharing. So I'll do a working 1 for him, a working 2 for him. So working 1, under the working 1, equity holders will technically get this 790. Is it 790? 730, no? So their share is 730. So equity holders share is 730. But from the subsidiary, they will get how much? 380 into, what is the percentage? 75%. Because 380 is the subsidiary's profit. Of this subsidiary's profit, they will enjoy 75%. So 380 is 75% is how much? How much? 285. And guys, don't forget, you had unrealized profits. So unrealized profits, directly when parent is selling to the subsidiary, that is 16,000. So I can deduct that 16,000 directly. However, there is another unrealized profit. Now this is parent to subsidiary, then the next one is subsidiary to parent. In that instance, the unrealized profit you need to calculate. So 8,000, right? Of this 8,000, I need to bear 75%. I need to bear how much? 6,000. So I need to deduct a 6,000. So then you will make the total profit attributable to the equity owners. Then in your working 2, you will calculate to the non-controlling interests. So in the non-controlling interest, from their profit share is how much? 380 into 25% they need to get from the business. What is that? 95. Then unrealized profits of that 8,000 also they will share only 25%. So what is that 25%? 2,000. So that needs to be removed. So their profits distributed among these two is going to be, here it is 93. So the non-controlling interest holders will get 93. Then equity holders will get how much? 990. 3. So equity holders will get 993. Did you understand that? The profit distribution? This part is very important. See the adjustments that I have made to the parent. So this is for the parent and this is for the non-controlling interest. So non-controlling interest needs to make 93, parents needs to make 993. Did you understand that? Okay. Let's have a break, and once we are back, you all can start doing activity 12. Okay? So let's go for a break, guys.